What's up guys, Kevin here, and I wanted to make this video simply to remind you that pretty much everybody filing their taxes qualifies for a tax deduction. I know this is typically something that in conversation, people assume that it's strictly reserved for the rich and people with a bunch of property and assets and things like that, but literally everybody that's filing their taxes should qualify for some form of deduction. Even if you're fresh out of school, fresh on your own, you should be able to fall into this category. So in this video, I just wanted to share some of the deductions that you should qualify for and how it works overall so that you have a better understanding of what you will expect when you file your taxes yourself. So let's go ahead and jump into it. Now, the key thing here to remember is a tax deduction is anything that takes away from your taxable income. So if you made $50,000 last year and you have $5,000 in tax deductions, you're only going to get taxed on $45,000 of what you made. So you made $5,000 that do not get taxed, and if you paid taxes on them, that's typically what you end up getting as a tax refund. So you want as many deductions as possible because that's going to reduce how much money you actually get taxed on, which reduces how much you owe and hopefully makes you eligible for a refund or at least minimizes how much you have to pay. So there are two types of tax deductions, standard and itemized. And we'll talk about the standard one first because this is the one that generally most everyone qualifies for. Again, even if you just started doing things and you don't have a house or children or anything like that, you still can qualify for this standard deduction. Now, the way that this is set up is basically the government has law that determined a certain amount of your income is just necessary to survive. So they're not going to tax that portion of your income. And depending on your filing status, that's going to determine how much income is not going to be taxed just on a standard deduction level. So you can see here how it's actually broken down. You either file single, married filing separately, married filing jointly, or as head of household. And this is all determined based on your situation and how you want to file. So even if you're married, you can file with your partner or separate from your partner, whatever makes the most financial sense. But the first standard deduction is $14,600 if you're single, or if you're married filing separately. It goes up to $29,200 if you're married filing jointly, which is literally just double the single deduction. And then if you're head of household, it is $21,900. So that's kind of how it's broken down. That's the amount that the government said this is the bare minimum you need just to survive. And if you made this much money or less, we should not be taxing any of the income you made. Another thing to consider is the standard deduction pretty much goes up every year. So this is actually an increase compared to what it was the previous year. And this is because they want to make sure that as inflation goes up, that we are matching with an appropriate increase in the standard deduction, because now the cost of living is higher. So your standard deduction should be higher to reflect that as well. And then the other thing to consider is if you are one of the people that are married but filing separately from your partner, you must both claim the same type of deduction. So if one person does standard, both of you need to do standard. If one person does itemized, then both of you need to do itemized. And speaking of which, let's talk about how itemized deductions work. And this is the one that I think more people are familiar with. Anytime, again, you see it in conversation, a millionaire buys a boat or a plane or whatever, and people are like, oh, that's a tax write-off. This is really what they're referring to as an itemized tax deduction. So the way an itemized tax deduction works is you go through all of the different things that fall into a category that's approved as a tax deduction. And if it's more than the standard deduction, you can do itemized instead. So for example, if you're single and you have, your $14,600 standard deduction, but you spent $15,000 on business assets, then typically it makes more sense to use an itemized deduction instead. And you can list out all the things that you paid for, submit that for your taxes, and then that should decrease the amount that you actually owe for that tax year. Now, the way itemized deductions are set up is they're primarily an option to help improve the economy and support businesses and things like that. So for example, if you have a mortgage, then the interest you pay is actually tax deductible. The same thing for donations that you give to charity. Anything that you donate, whether it's cash or an actual product, furniture, clothes, whatever, the value of that donation is tax deductible as well. So usually when you do these things, you get some kind of receipt, or like at the end of the year, you get some paperwork that tells you what you gave, and then you're able to put that on your tax form as a tax deduction. Even things like local and state taxes that you paid in the prior year are going to be tax deductible. So you want to make sure you capture everything on here and list it on your form. but depending on the actual tax deduction, it may not make sense because your standard deduction is going to be more anyway. So again, in the case of like a married person, if you don't have more than $29,200 worth of itemized tax deductions that fall into these categories, then it's not going to be worth itemizing your deductions anyway. So I put all this together really just to say that tax deductions are a good thing. I think we all can agree, even though the assumption is that only millionaires are taking it on their houses and their cars and stuff like that. In reality, we all benefit. I think most of the people that get mad at the idea of a tax deduction aren't hating it so much as they are mad at people that are abusing it, which definitely does happen. For example, if you do have a car that's purely for your business, that's completely okay to make it tax deductible. You're using that to run your company and support your employees, so that's really how it's supposed to be used. But if you just happen to own a business and when you buy a Lamborghini, you claim it as a business expense, even though you only use it for personal use, then that is, of course, a complete abuse of the system. That's something that typically gets run through the legal system, and you can end up owing a lot of money on back taxes, along with interest and fees and things like that. So highly not recommend doing that. But otherwise, I think we all should celebrate the tax deductions that we do qualify for and push for more of that in the system to help support the economy. So yeah, I think that's it for this video. Thank you guys for stopping by. Don't forget to like and subscribe, and I will see you on the next one.